risk appetite, and how it affects your decisions. I personally tend to invest in stocks that are considered risky, but if your personal appetite for risk might be different from mine, so I'd like to take a moment to help you figure out what is your risk appetite. High risk. You are comfortable with the possibility of day-to-day price swings of 5% plus. You can stomach buying a pharmaceutical stock before the FDA has approved the company's leading drug candidate, knowing that if the FDA does not approve the drug, the company could be worthless. You are willing to buy stocks with little to no dividends or earnings. Moderate risk. You will only buy companies with historically stable day-to-day prices. You avoid large swings in favor of steady movements. You will only buy companies that are currently selling a product to consumers. You prefer stocks that have dividends and/or positive earnings. Risk adverse. You prefer to keep your money out of the stock market in favor of fixed income instruments. These categories are not all encompassing, and some of you will be in between somewhere. They are just here to help you get an idea of how much money you can stand to lose. It's also important to realize that there is always some level of risk when you invest, even when you choose what are considered to be safe investments. Before the housing crisis, investments in housing mortgages were considered to be among the safest you could choose from. I am guessing most of you watching this video identify with one of the first two categories, but if you identify with being risk adverse, that is okay too. I hope that by the end of this course, you have the confidence you need to start investing. As I said, I tend to gravitate towards the higher risk stocks simply because they offer the greatest return potential. But I've been known to buy into safer dividend paying stocks if I find one that appears to be undervalued. And that is what's really great about investing. It's all about finding the great deals that other people did not see. Why is it so important to know your risk appetite? Well, if it can prevent you from making rash decisions in the heat of the moment. Someone with the high risk appetite can likely handle seeing their shares drop 20% better than someone with risk adverse appetite. The person with the risk adverse appetite is more likely to sell their shares to cut their losses as soon as possible, whereas the person with high risk appetite is more likely to give the stock a chance to recover its losses. And so it is extremely important that you are able to accurately identify how tolerant to risk you are, because selling a stock just because the price has dropped is a bad decision. What you should really be doing is figure out what caused the price drop. For instance, it is not uncommon for someone to write a baseless article about a company with the sole intention of affecting the price. All it takes is one headline to say Apple is a bad investment, and there are investors out there who will sell after just reading that title. Does this make any sense? Of course not. We haven't even found out yet why the article claims that Apple is a bad investment, let alone if the argument in the article is credible. Maybe the writer simply wanted to convince people to sell the stock so he could buy at a better price. This sort of manipulation is technically illegal, but is a factor in today's market. But the smart decision is to hold on to your shares of Apple because you've read the article and realize everything that the writer claims is nonsense. On the other hand, maybe there is a perfectly valid reason for the stock price to have moved. Maybe Apple has announced its newest iPhone is a complete flop, in which case you should not sell, but you should begin to consider the possibility of selling. And specifically say consider selling because you should never make a buy or sell decision based solely on a single piece of news. Maybe the reason Apple expects its iPhone sales to perform poorly is because customers are instead buying far more iPads than expected. It is important to dig into any and all news pieces and determine not only their legitimacy, but also whether or not they mean something. Good or bad news for your shares. It's quite possible that the iPad is selling more than expected and will cancel out the iPhone's underperformance. And there are many cases where a particular announcement at first seems like great news for a company, but it actually turns out to have a negative effect on the share price, and vice versa. When you're reading market news and doing your own stock research, you should never take something at face value. There is always another viewpoint to consider, and you have to force yourself to think of every viewpoint you possibly can. You can find yourself reading a lot of articles that suggest a particular stock to buy. Take it upon yourself to find and read the articles that argue that the stock is in fact to sell. You must be open to any and all commentary and simultaneously decide what is credible argument and what isn't. Only then can you say you've made an informed decision. Not only will this way of thinking help you uncover good investments, it can also turn a risk-averse individual into someone who is comfortable taking on more risky investments. The more you know, the more money you will make.